is quantitative easing, finding the right balance. So my project centered around looking at the experiences of quantitative easing in both Japan and the United States. So I was looking at what was successful, what could have been improved, and originally I thought that I was going to take a look at the mistakes that were made in Japan and make a recommendation to the United States. But as it turned out, the Japanese could learn a lot more from the United States than the other way around. So my presentation is going to start off with defining non-standard versus standard monetary policy. And then I'm going to look at both countries, take a look at what it's like currently, and then make some recommendations to improve their policies. So to start off, we have to define standard monetary policy. This is essentially Ben Bernanke's toolbox. These are 3 monetary policies that all affect money supply. So first, the discount rate is the rate at which banks can borrow directly from the Federal Reserve, and it's directly tied to the federal funds rate, which is the rate at which banks can borrow from one another. So in order to decrease the interest rates in the market, you need to increase the money supply. This is because more supply equals lower price. As scarcity would increase the price. And in this case, the price is the interest rate, the price of money. So to decrease the interest rates, the Federal Reserve would decrease the discount rate, and that makes it easier for banks to borrow from the Federal Reserve and each other, so there's more money flowing through the system. And the vice versa is also true for increasing the interest rates. The second policy is the reserve ratio, and that's the percentage of deposits that an institution must hold on to, meaning they can't lend it out and they can't let people withdraw it. So to decrease the interest rates and increase the money supply, the reserve ratio would have to decrease, allowing banks to lend out more of the money that they usually would have held in reserves. And again, the opposite is true to increase the interest rates. And finally, the last alternative is the open market operations that consists of both purchases and sales of bonds, treasury securities. So in order to decrease the interest rates and increase the money supply, the Fed would conduct open market purchases. They would be taking the debt held in bonds back from the public and exchanging that for money. So money is going into the system, which increases the money supply. And if they wanted to increase the interest rates, they would conduct open market sales. And we want the interest rates to be low because they encourage consumer spending, investment, and capital inflow, and that contributes to economic growth. So there is one reason why these 3 standard monetary policies wouldn't work, and that is when the short-term interest rates are too close to 0, and that makes monetary policy ineffective. And we have 3 alternatives if that occurs. Those are the non-standard monetary policies. The first is qualitative easing. That is referring to the decreasing of the riskiness of assets held by the public. So you might be buying risky assets and selling safer assets or vice versa. Then we have Operation Twist, which is the changing of the length of maturity of assets in the market. So the Federal Reserve might buy long-term treasuries and only sell short-term. And finally, quantitative easing has to do with increasing the size of the federal bank's balance sheet. And that's usually holding risk constant unless it's used with qualitative easing. So when I refer to quantitative easing, I could be referring to any combination of these 3. And you might hear me refer to QE throughout this presentation. I mean quantitative easing, not qualitative. So I'm going to start off by looking at Japan. There were 3 main causes of the financial problem in Japan. The first was the real estate bubble burst. These banks had very risky property and land businesses in their portfolios, and that can decrease their value. Secondly, they were allowed to hold common stock in their portfolios, and the stock market has a lot of fluctuations. Their bottom lines were changing rapidly. And then there was deflation, which was caused by non-performing loans. Non-performing loans are loans that are in danger of or already in default. The second cause were zombie banks. So right after the bubble burst, there were financial institutions that had more liabilities than they had assets. Meanwhile, there were these lands and stock prices were decreasing, and that was causing portfolio changes, and then the fixed liabilities were remaining constant. So there were a lot of banks that had negative net worth. Instead of letting these negative net worth institutions fail, the Bank of Japan was worried that that would cause a deeper recession. So they started bailing out hundreds of them using stimulus money, which of course was borrowed. And through the bailouts, these banks were allowed to hide their losses in unfavorable loans, and that led to zombie banks. And zombie banks are institutions with a negative net worth, but they're still operational. They're not really loaning out anything because no one really wants to borrow. Everyone was worried about the economy. So instead, they were putting all of their money into savings. And the savings were increasing over time, but the interest rates were really low. And when you deposit even more into a savings account with a low interest rate, the interest rates are driven even lower, which causes a bigger problem. And lastly, there was a liquidity trap. Because people were saving rather than investing, consumption was decreasing, investment was decreasing, and that causes aggregate expenditures and aggregate demand to decrease. That causes price decreases, and the GDP deflator fell, and that led to deflation. And that combination of, or that series of events is referred to as a liquidity trap. And that should sound familiar because it's happened in the United States as well. So here we see, right here, where we have the short-term interest rates are very close to zero or at zero. And that means that the Federal Reserve, or the Bank of Japan in this case, can't lower the interest rates any lower to stimulate growth. It's already at zero, it can't go negative. So there were 5 main causes that we can summarize that happened in Japan. The first one was inadequate policy operations, which the government was decreasing taxes, but only so much that there wasn't really an impact after that. People weren't spending what they were saving from the tax decrease. Secondly, we had savings and investment imbalance that I just talked about, and that was causing an equilibrium price, real interest rates to go into the negatives because of the excess supply was, as I said, was driving the interest rates lower through the banking system. And then there was a low rate of return on capital, and that caused overinvestment in banks in the 80s and caused interest rates to fall and encourage savings. There was also lax accounting regulations that allowed the zombie banks to continue operating while trying to write off their bad debts. And finally, there were non-performing loans that were reflecting severe debt in the corporate sector as well. So now we have problems in the corporate sector and in the banking systems. So in order to implement quantitative easing, the Bank of Japan started increasing their purchases of Japanese government bonds from 400 billion yen per month to 1,200 yen per month, which is a significant increase. In order to maintain public support of the policy, they made this promise that they were going to continue quantitative easing until the CPI reached 0%. And they did make good on that promise. They kept the policy going until March 9th of 2006, when they decided that the condition had been met. So the duration effect, which was the public policy promise, was a success. It did convince the public that the Bank of Japan was serious about the goal and was going to do everything that they could to maintain it, and that encouraged positive economic recovery expectations. There was also, the liquidity was a success because they increased the short-term bond supply in the market. And deflation was somewhat of a disappointment. Although the duration effect had a positive impact on communication, it failed to reserve deflationary expectations in financial markets, since monetary policy alone couldn't reverse deflation coupled with low economic growth. And finally, the signaling effect did assure the public that the Bank of Japan was trying to fix the problem, but it did not strengthen any monetary easing expectations. So moving over to the United States, there was one precursor to the Great Recession dating back to the Community Reinvestment Act of 1977, with the intention of encouraging depository institutions to help meet the credit needs of the communities in which they operate, including low and moderate income neighborhoods consistent with safe and sound operations. The banks, however, were not encouraged to lend to unqualified people. Making a loan to an unqualified person could lead to potential losses, and the unforeseen consequence of that was a high rate of foreclosures, and that has been tied directly to the Great Recession. The next event was the savings and loans crisis of the 1980s and 90s. It started back in the late 1970s when banks were encouraged to lend to market segmentations that were previously deemed unqualified for loans. And then the Tax Reform Act came along in 1981, and that gave tax incentives to individuals to invest in real estate, and that contributed to overinvestment and overbuilding. And then 5 years later, the Federal Savings and Loans Insurance Corporation was declared insolvent, so the Tax Reform Act was halted, and the slow response time in closing insolvent banks contributed to the problem as well. Finally, Lehman Brothers filed for bankruptcy on September 15th of 2008 after 158 years of operation. An internal exam of their finances in March of 2010 showed that they had been using less than reputable accounting techniques to cover up some financial losses and some instabilities, and that gave kind of an inaccurate representation of their financial conditions for 2007 and 2008. They were also really affected by the subprime mortgage crisis of 2008. They had some losses incurred by holding on to some risky mortgages, and their stock value decreased by 73%, which is very substantial. And the subprime mortgage crisis was caused by these risky lending for mortgages for people that might not have really been able to afford it, but the rates were fixed at a time for about 3 to 5 years, depending on the mortgage. And after that period, the interest rates were reset, so a lot of people's interest rates went up. Some people could afford it, and some people couldn't, but because of the bundling of the mortgages into mortgage-backed securities and being sold off to different companies, there was a lot of contagion throughout the markets from just one bad loan, which caused a big problem for the Great Recession. So this is a timeline of the Great Recession. I just talked about these first three. So from 1986 up until 2007 is when we start seeing the mortgage crisis. And now we're at 2007. The Federal Open Market Committee decreased the federal funds rate. That's a standard monetary policy. And on December 7th, we're declared in a recession. The following January, the Federal Open Market Committee sells Treasury securities, which is, again, a standard monetary policy. And they decrease the federal funds rate again to 2%. But September, we're at unemployment of 5%, which sounds pretty good right now. The same month, Fannie Mae and Freddie Mac were taken over by the US Treasury. As I said, Lehman Brothers went bankrupt on the 15th. And the same month, quantitative easing 1 is implemented. That's our first non-standard monetary policy. Despite that being implemented, unemployment still rises, 6.5 in November, 7.2 in December. And then the following February, President Obama signs a $787 billion stimulus package with 2 more to follow. And still the unemployment rate rises in November to 10.2%. That's the high of the Great Recession. In 2010, quantitative easing 2 is announced. And the following year, Operation Twist, right after the unemployment rate had come down a little bit to 8.9%, but we had another setback when the S&P 500 downgraded the US credit rating from a AAA to a AA plus with a negative outlook. And finally, quantitative easing 3 was in September of 2012, and that's still going on right now. This is a comparison of quantitative easing 1, 2, and 3 in Operation Twist. The first one was purchases of high-grade securities like agency debt and long-term government bonds with the intention of easing liquidity and credit conditions and lowering the unemployment rate. Quantitative easing 2 was only the purchases of long-term government bonds to eliminate the fears of deflation and decrease the money demand to resolve monetary disequilibrium. Operation Twist was the sales of short-term bonds and purchases of long-term government bonds to lower the long-term interest rates. And finally, we're still in quantitative easing 3, which is purchases of $40 billion in mortgage debt from banks per month to reduce the interest rate without inducing inflation. Okay. So to start quantitative easing, the Treasury started borrowing in advance of its needs and depositing those funds into the Federal Reserve. And through fiscal operations, the Fed was able to increase assets without increasing the individual bank reserves. The goal over this time was to decrease risk premiums, but stopping the bailouts of failing financial institutions. And to reduce interest rate risk premiums on risky assets, the price must increase because risk premiums and prices are inversely related. So the implementation worked in 3 distinct channels. The first was the supply channel that refers to the availability of assets in the market. The scarcity of treasuries caused by the Federal Reserve purchasing all those treasuries drove the price up. And that can be seen through this model. This is a very simple model of future value. Future value equals present value times 1 plus the interest rate, raised to the power of t years until maturity. So we see that the price or present value is increasing. In order to hold future value constant, the rate has to decrease. And the interest rate is synonymous with the yield curve, so the yield curve has been reduced. There's also the liquidity channel, and that had to do with overall liquidity in the market. Liquidity refers to how easily an asset can be converted into cash. So a short-term asset is more liquid than a long-term, which is more liquid than like your house. So quantitative easing increased the supply of liquid assets, which are like bank reserves instead of long-term treasuries, and that increased the supply of short-term bonds. Decrease the price, decrease the premiums, and raise the interest rates, just like you see in the bottom. We have decrease in present value, increase in the interest rates. And finally, the duration channel had to do, again, with the public policy. So they were tying everything to a financial condition so that people could time their portfolio changes around it. So the successes of quantitative easing in the United States, we're meeting quantitative easing 3 as outlined by the Federal Reserve. And we use quantitative easing, qualitative easing, and Operation Twist, which proved to be much more successful than the Japanese version that employed only quantitative and qualitative easing. So Ben Bernanke would tell you that his policies were completely successful. The only downside is that during the process, we tripled the money supply, and that could lead to inflation in the future. Quantitative easing 1 and 2 also decreased the rates by increasing the prices of assets to increase economic activity and growth by dissuading investors from putting their money just into safe assets. And that was successful by lowering the 30-year interest rates over the period of 2008 to the present from 6.1% to 3.1%, which is very successful. So finally, these are my recommendations on the current state of affairs in both countries. In Japan, they currently suffer from a huge amount of debt. It's unsustainable. They also have a problem with the number of people that are in the workforce. They have a really low birth rate, and most of their population is in retirement age. That means there's not very many people working. And in order to pay back the debt that they have, they would need a lot of production. So it's kind of a problem. So my recommendations were to do inflation targeting just how they did with duration targeting. They have to tie the inflation rate to a target in order to convince the public that it's going to work. They should also be following the US example, exactly what we did, but a little bit different. They need to be committing to that first policy of the inflation target, increasing real interest rates, putting more stimulus money in, and pushing down the long-term interest rates on long-term bonds. And I'm saying yay because my recommendations were actually taken before I even got a chance to say them, which is kind of weird. That never happens. So they just elected a new governor of the Bank of Japan. His name is Haruhiko Kuroda, and he has declared that he's going to do inflation targeting. I just said that, of 2%, yay! He also is increasing the purchases of JGBs, which are Japanese government bonds, so instead of by 50 trillion yen per year, which is very substantial. He is going to be buying 7-year bonds and more risky assets instead of just the 3-year bonds. That's going to help with the long-term rates, as I just said, and that'll spur economic activity because it'll be easier for corporations to invest. For the United States, currently QE3 is working, as I said. We're almost done with it. We do have some impediments to complete recovery. The first is gas prices, which affect pretty much everything. In America, gas prices are pretty much a necessity. I mean, you have to get to work. You can't really walk on the highway, so it has to be done. That kind of rolls over into everything else. If I have to spend more money on gas, I'm probably not going to buy a big screen TV. I'm not going to get a new car. I'm not going to upgrade the size of my apartment. We also have a high rate of unemployment. It's been decreasing for the last 3 years, which is a good thing, but it's still at 7.6%. That's pretty high, especially, like, we would love it to be 5%, and that's still high. And my recommendations were to stimulate some job creation instead of just these little projects of here, go experiment with this and let me know how it goes for 2 months. Instead, we're looking at things like public works projects, sending people into floundering cities like Detroit and Cleveland, cleaning things up, increasing the property value, help the real estate market, make it into an economic hub of activity, and that will help the entire nation. At the same time, you might want to think about lowering taxes, and that's kind of difficult to do. Maybe revising the tax code is a better perspective, thinking about instead of an income tax, a progressive tax or a consumption tax. These are all things that people have been thinking about, but they're kind of slow to get started. And that kind of needs to be done because if you look at it, I have public works projects that cost money, and I'm lowering taxes, so where do you get the money to do it? So that's still in the works. They're thinking about it, and also looking at the federal budget and eliminating some stuff. So quantitative easing is almost over in the United States, but we're far from a level of stability that the American public felt in decades past. And it's really important that the United States stays in the forefront of economic activity because the global market is shifting. And we need to be kind of embodying this perspective of stability and growth and development for other economies to follow. And that's it. Thank you.